They are. It'll probably start around May 10th, 11th, 12th. Do what? They need to, they need to tear it down and just start over. What they need to do. Yeah. I don't know.
Someone's embezzling is what you're saying.
I'll tell you, it's not going to pay raises for faculty either, okay? All right, let's try this today. If my voice kind of sounds like I swallowed a frog, it's because I am continually fighting allergies. Don't ask me how somebody for the first 30 years of his life spent hours and hours and hours outdoors and never was allergic to one thing. Contracted allergies at about 30 years old, and now they're about to kill me, okay? Some people are going to die of heart attack. Some people are going to die of something else. I'm going to die of allergies, okay? I'm going to, I think. So I don't know what it is, but it seems like every day some days I wake up, I'm great. Today, not so great. So it's just a mystery. So we're going to try to get through this. All right, a couple of reminders. One is quiz number 4 for you. Closes, and that covers chapter 6, which is the bond valuation chapter. That closes tonight at 11:59 p.m. And then quiz number 5, which covers chapter 7, which is bond valuation. We're going to cover a lot of that today. Wait a minute, stock valuation. Bond valuation chapter 6, stock valuation chapter 7. It's going to open today at 2. It's going to remain open until Saturday at 11:59 p.m. So we'll cover that today and Thursday. And then that will be all of your quizzes for the semester. Okay? All right, are there any questions about anything to this point? Class, scheduling? Anybody want to switch and be a finance major? We don't need that even. We need, yes, I want to be a finance major. Okay, if anybody does, feel free to come by and talk to me, or the other finance faculty. We've got 4 finance faculty. They're all really nice people, I promise. I mean, I tend to be one of the nicest, but still, that's just my opinion, okay? We've got lots of classes that we're offering, lots of new classes. So if you are interested, if you're in something that you're like, hey, and I have a lot of people come talk to me this time of year, okay? So it's not like you will be the only person coming to talk to me. I've already had probably 5 come talk to me last week. But if you are interested, come by and see me or talk to one of the other finance professors. We'll be happy to discuss it with you, even if you are currently with another advisor. For example, if you're at the advising center with Ms. Johnsonis, you can still come talk to me, okay? We can kind of discuss things and do a what-if analysis, that type of thing. All right, so let's pull up chapter 7, stock valuation. And I really apologize to the online students who are listening to this because I'm probably coughing and clearing my throat in their ear. So let me just go ahead and apologize to you for that. Okay, now in chapter 6, we talked about bonds. We talked about bonds a couple of different ways. One is we went through bond valuation, and we went through and how do you price a bond. That's what your quiz number 4 covers. We also talked about bonds in terms of how corporations can raise money. So if corporations need to raise money for, and I've used the example of a new factory, one way is they can issue bonds. But also, they can issue stock, which is what we're going to talk about in Chapter 7, as stocks tend to be a little more exciting to students than bonds. Now, first thing you have listed here is the difference between debt and equity. Now, in Chapter 6, when we talked about bonds, we said bonds were a form of debt. What that means is bonds are a legal obligation. The interest on bonds has to be paid. So it's just like if you borrow money from a bank to buy a car and you sign your name on the loan agreement that says you're going to pay them back, you have to pay them back. What happens if you don't pay them back for your car loan? They'll repo it. They'll come get your car. They'll probably ask you to bring it in first. If you don't, they'll come take it. Then they'll sell it to try to pay off your loan. What if they can't pay off your complete loan balance by selling your car? Then what's going to happen? Do what? They could. They'll probably, depending on the amount, they'll probably take you to court, and they may place, they could garnish your wages, or they may take some kind of other type of legal action. But they're going to try to get their money back because it's a legal obligation. Bonds are the same way. Now, when it comes to stock, stock is what we call equity, or stockholders' equity, or owner's equity. So what that means is, instead of it being a legal obligation or a loan, stock is simply ownership. So when you buy a share of stock in a company, it is a form of ownership. You are an owner of that company. So if I buy one share of Ford Motor Company stock, I can say I'm an owner of Ford Motor Company. Now, truthfully, I'm a really, 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 really small owner. And my one share of stock that I own really doesn't make a lot of difference, but still, I'm an owner of Ford Motor Company. And if you take a look at this, this kind of sums up the other couple of bullet points, what I just said, in terms of the difference between debt being a legal obligation, equity, as we'll talk about in a minute, typically pays dividends, and dividends don't necessarily have to be paid legally. They can be passed if the company's having a bad year. If the company's having a bad year when it comes to interest payments, they still have to scrape up that money to make those interest payments, or typically bankruptcy is soon to follow. So you can see some differences here between debt and equity. For example, when it comes to equity or stock, does it have a voice in management? Yes, stockholders get to vote. So they get to vote on who sits on the board of directors for a company. That can be a pretty powerful opportunity. Now, typically, you get one vote per share of stock that you own. So if I own one share of Ford Motor Company and I get one vote, and there are, and we can look it up, I don't know exactly, but hundreds of millions of shares of Ford Motor Company stock outstanding, my one vote's not going to make much difference. Okay? But I still get to vote. If I'm a bondholder, I don't get to vote. Okay? Claims on income and assets, as we'll see in just a minute. Bondholders get paid first. Stockholders get paid last. Because there's a certain way that if a company goes bankrupt, that who's paid first, who's paid second, who's paid last, and typically stockholders are at the very bottom of the list, and normally nothing's going to be left over for the stockholder. Maturity, bonds have a stated maturity date, as we talked about in Chapter 6. Stock does not have a maturity date. And then tax treatment. One of the benefits of debt is that the interest on bonds is tax deductible. That's a big benefit to corporations. The dividends on stock is not tax deductible. So that's kind of a drawback to that. Now, let me ask you this. If interest on bonds is tax deductible, which means typically bonds are the cheapest form of raising money for a corporation, why don't all corporations use all debt or bonds or borrowed money all the time? Why do they even fool with stock if using debt has this interest deduction and it's typically cheaper, at least initially when you start out, it's cheaper? Why don't all companies use all debt all the time? It's what? That is true. But for the company, are you talking about in terms of trying to? Okay, so trying to entice people to buy your bonds versus your stock. Okay, that's good. What else? Okay, so that is true too. That is true too. Stock prices fluctuate typically more than bond prices. Now, what about this interest payment? And what about the risk level? Now remember, I said that interest payments have to be made. So when a company first issues debt, if it's pretty strong financially, that company and investors, they don't expect a really high rate of return because maybe they're not taking a lot of risk. But what happens to the risk of a company being able to make those interest payments as a company issues more and more and more debt? Because that means they have to pay more and more and more interest. So what happens to the risk level of them being able to make those interest payments? It goes up. That's exactly right. It increases. And as the risk level increases, what happens to the rate of interest that the company has to pay on the bonds that they're issuing? You can use finger motions, up, down. That's right. It goes up also. So what happens is, as companies issue more and more debt, the risk level of being able to make those interest payments and pay off the par value of the bonds increases to the point where bankruptcy becomes a problem. And investors like you realize that, you know that, and so you know that after a certain point, it isn't a good investment, or the return that you're going to receive in terms of interest from the bonds is not going to compensate you for the risk that you're taking. So that's why companies tend to split up raising capital. They'll use some debt, they'll use some equity, or some bonds and some stock. And different companies do it different ways. Some companies use all stock, no debt whatsoever. Some companies might use 50% debt, 50% stock, or 20% debt and 80% stock, or whatever. I mean, it's just up to management in terms of the best way to do that, and that's called capital structure, and we'll take a look at that a little bit later in the semester. All right, so the differences, and this is talking about the voting rights, and I've already discussed this some, so I'm going to skip through this. This is what we discussed earlier. It's just a little side note in your book, but it's basically saying, what happens if a company goes bankrupt? Does anybody get their money back? Well, sometimes. The way it works, as you can see here, if a company goes bankrupt, is that any secured creditors, that means that there is some type of collateral securing a loan, they're typically paid first. Well, let me take a step back. Employee wages, any back wages are paid first. Government-backed taxes are paid next. Secured creditors are then paid. Unsecured creditors are then paid. That means people who have loaned the company money with nothing to back it up, no collateral. And then finally, you have equity holders or stockholders. Guess how much is left over for the stockholders by the time the company gets finished paying everybody else? Nothing. Okay, that's exactly right. So if you're a stockholder in a company, especially common stock, and we'll talk about the difference between common stock and preferred stock. If you're a common stockholder in a company and it goes bankrupt, your stock is worthless. You're not going to get anything for that stock, okay? Well, there's different types of bankruptcy. So when a corporation files bankruptcy, they can either file for reorganization. Individuals can do that also. What that does is it simply holds the creditors off, the people who have loaned the money, until they can reorganize what they've borrowed. They can renegotiate contracts. Because they want to keep going. They want to keep operating as a business. Or they can simply file for liquidation, which means the company's going out of business. They're selling all their assets. They're paying off all their creditors. And that's kind of what we're talking about here, okay? With an individual, it's kind of the same thing, although with individuals, typically all they have are creditors, okay? They don't have any kind of equity because nobody has invested in that individual. Okay, so it's a little bit different, but you can still file for protection if you're an individual. So you can, some things you may want to keep and try to pay off, some things you may let go back to the lender. Okay, you may have a car and a motorcycle. You may say, I want to keep my car, I want to keep trying to pay it off. You may let the motorcycle go back to the lender and let them repossess it and sell it. You do have those options sometimes. Okay, and we discussed this also, so let me jump ahead. And we talked about the tax treatment and the tax deductibility of interest. Okay, types of common stock. You see two different types here. Common stock we'll look at in just a minute. I want to spend a few minutes talking about what's called preferred stock, and this is defined as a hybrid security with characteristics of debt and equity. So in certain ways, it's like a bond. In certain ways, it's like a share of common stock. Now, keep in mind, all companies don't have preferred stock. Some choose to use preferred stock, some don't, and it's just up to the company. But the debt characteristics are, it has a par value, just like bonds. It pays a fixed dividend, so that's similar to the fixed interest payment that bonds pay. It takes a senior position to common stock, to the dividend, and it says some preferred stock actually have a maturity date. You hardly ever see that, okay? So they do have that in your book, but you hardly ever see that. Now, how does preferred stock act like common stock? Well, common stock also has a par value. The only difference is the par value for a bond means something. The par value for preferred stock means something. The par value for common stock typically doesn't mean anything, okay? It's normally just a bookkeeping entry. And then with preferred stock, the dividend can be passed by directors if financial conditions warrant. Now, let me explain what this is referring to. When it comes to preferred stock, there's two different types. There's what's called cumulative preferred stock and non-cumulative preferred stock. What that means is, let's say that a company has a really bad year financially. And not only can it not pay its common stock dividends, but it can't make its preferred stock dividends. Well, if it's a cumulative preferred stock, let's say we have 2 years worth of bad years. We don't pay our preferred stock dividend for 2 years, but we have issued cumulative preferred stock. What that means is that the company has to go back and make up any missed preferred stock dividends before it can make a common stock, before it can pay a common stock dividend. So they accumulate. If it's a non-cumulative preferred stock and the company misses paying the preferred stock dividends for 2 years, it doesn't have to go back and make them up. It's just the next year, if they have a good year financially, they pay their preferred stock dividends first, and then they can pay common stock dividends if financially they can do so. So that's the difference between preferred stock cumulative and preferred stock non-cumulative. And again, it depends on the company as to what they issue. They have, they've got choices in terms of what type of stock they want to issue. Now, this is pretty important, the first bullet point here. You probably will see this on the final exam. You may actually see it on quiz number 5, okay? That's bullet point number 1. All right, good job. What it says is that common stockholders are referred to as residual owners of the firm. This means they're the true owners of the firm. It also means they are paid last. They get whatever's left over, they get paid. And that's what it explains in the second bullet point. Now, basically, common stockholders are assured of only one thing. If you invest in common stock, let's say, for example, you buy $10,000 worth of Google stock. Well, let's buy Amazon stock. $10,000 worth of Amazon stock. You can only lose $10,000. That's it. Now, you're not going to be happy about it, but there are certain investments where you can actually lose more than you've invested. Now, what I'm talking about here is I'm talking about a straight long position in Amazon common stock. A long position means a buying position, okay? That's different than a short position where with if you short a stock, you're expecting the price of the stock to actually go down in value. That's how you're going to make money on it, okay? But I'm talking about just a basic purchase. You can buy $10,000 worth, Amazon goes broke, you lose 10 grand. That's it. And because of this uncertainty, common stockholders expect to be compensated with dividends and ultimately capital gains, or in other words, they want the price of their stock to go up. Now, the reason that common stock is so popular among investors is because you can make a lot of money in the stock market. You pick the right stocks, you get on Amazon stock when it's early and it's a low price, you're making a fortune. You buy, Facebook stock early, Twitter. You bought Walmart early in its life. It hasn't done a lot lately, but early in its life, Walmart exploded. Tesla Motor Company. Tesla Motor Company, which has very few cars operating on the road compared to Ford or General Motors. Tesla yesterday became the United States' most valuable automobile manufacturer. And how many Tesla model cars do you see on the road? Not very many. So why would it, now this is in terms of stock value, market value of the stock. Now what this says to me is investors are really excited about the future of Tesla Motor Company. Now, is that excitement warranted? Maybe, maybe not. That's why we play the game. If you invest, you don't mind taking a little bit of risk, and sometimes you want to take a lot of risk. For example, I invest in some stocks that tend to be risky. That's kind of what I call my, I don't know if this is the right word, but play money, or money that if I lost it all this week, I could still eat next week. On the other hand, my retirement money, typically I have most of that invested in mutual funds, and they're still invested in the stock market, and it's still fairly aggressive, but it's not as risky as investing in just a single company stock. So, for example, Tesla Motor Company. At one time, I owned Tesla Motor Company, owned some shares of it. And we'll see, we probably won't get to this today, but on Thursday, I will bring up, and it's going to look like this. Let me jump ahead really quickly. It's going to look like this. Well, this is going to be an entire screen of these stock prices. So what you're going to see, these are going to be changing colors. There's going to be reds and greens and flashing lights and everything. And so we're going to look at the price of some companies, and we're going to watch them change as I'm discussing the different companies. And so I'm going to go through this and kind of talk to you about, if you want to start trading stocks in the real world, how do you do that? What's the process? And so I'm going to go through and talk to you about, what all of this means across the top, and how do we use this in terms of helping us to buy or sell stock. Okay? But again, that'll probably be Thursday. Now let me jump back here. Somewhere, okay. So I was talking to you about Tesla, and one time I owned Tesla Motor Company. I bought it, and as I said, it's trading now for north of $300 per share. I bought it when it was selling for, I want to say it was selling for $28 per share. And I bought several shares of Tesla Motor Company. And at that time, this was back probably 5 years ago, 4 or 5 years ago, and it was really volatile. It's still volatile, but it was really volatile. It'd be at 28, and it jumped to 30 or 35 or 40, then it dropped down to 25. And I bought and sold stocks for quite a while. And one thing that I do a lot that drives me crazy, and I was trying to get away from it, is I will buy a stock, I make a good pick, I watch the price go up, but then I keep holding on to it as the price, for some reason, starts going back down. And each day that it starts dropping in price, I'm an optimist, okay? I'm a glass half full kind of person, so I'm thinking, well, yeah, it dropped in price today, but tomorrow that price is going to go back up, and it goes back down. Then I think the next day, the price is going to go back up, and it goes back down. So several times, I bought a share of stock at a certain price, watched it go up, maybe double or triple what it was worth when I bought it, watched it come back down to the original selling price or around there that I bought it for. So I've lost a lot of money. I've left a lot of money on the table. So with Tesla, I'm like, you know what? I'm learning from those mistakes. That's not going to happen. So I bought Tesla. It might have been $30 per share. And within 3 weeks, it had jumped to $40 per share. So if you do a percentage return, like we talked about in chapter 8, that was a 25% return in a month's time. That's a really good return on your money. So I said, you know what? That's it. I'm not going to be greedy. I'm going to sell at 40. So I sold my, whatever it was, 100 shares or 150 shares of Tesla, 200, I don't know how many it was, at $40 per share. And I thought, damn, I am one of the world's best investors. Look at that. I made 25% in a month. That's fantastic. As I watched the price go to 50, and then to 60, and then to 80, and then to $100 per share. And around 80 or 90, I looked at it again, and I thought, you know what? I might have made a mistake. Maybe I should jump back in on this Tesla stock at 80 or 90 or even $100 per share, because it might have it might have legs, which means the price is going to keep going up. But there were a couple things that kept me from doing that. One was pride, because I'm thinking, you know what? I sold at 40. If I buy it at 90 or 100, man, look at all the money I lost. I could have made 5. But also, again, Tesla they just weren't selling a ton of cars. I mean, yeah, they've got more now, but at the time, they weren't selling a lot of cars, and they were having some technical issues. So I decided not to, and watched the price steadily go to 150, 200. They dropped back down for a while, and like I said, now they're at like 325 or something like that. I don't know what it is. But anyway, it's enough to really make me sick if I do the math. But that's part of investing, okay? You can't worry about what you lost. You have to just look at, okay, I'm doing the best I can. And yeah, I left a lot of money on the table. But then again, I could have watched Tesla come back down to 30. So you just never know. That's what makes it interesting. And I've got a couple other stories, some success stories, some not so successful investment stories that I'll share with you when we actually take a look at the stock prices. Okay, so a couple things about common stock. One is that it does have a par value. It says here, this is an arbitrary value established for legal purposes. So basically, the par value of common stock means nothing. Now, with a bond, the par value means a lot. Typically, it's 1,000. With preferred stock, the par value means a lot because preferred stock typically pays a fixed percentage of its par value. So it means something to us. But for common stock, it really doesn't mean much, as we'll take a look in just a second when we pull up. Let me jump ahead and I'll go back. Pull up. This is what the stockholder's equity of a balance sheet would look like. And so you can see here, for this particular stock, it has an 80-cent per share par value. They've authorized 35 million shares. They've issued 15 million shares. And then they've got something called paid-in capital in excess of par. Somebody tell me, what is that? What is paid-in capital in excess of par? And what does it have? What's it have to do with? Okay, now remember, I said that, oh, because, that's, okay, this is, okay, yes and sort of yes, okay? What it is, because remember, this is when the company's selling stock. So what this means is this company has they've authorized to sell up to 35 million shares of their common stock to raise money. So far, they've only sold 15 million shares. And when they sold that 15 million shares, they sold 15 million times 80 cents is $12 million. That's what they raised. And then they also raised $63 million in additional money from those shares of stock. So if you take this 63 plus 12, the $75 million, divided by 15 million shares, originally they sold their stock for $5 per share. That's 75 million divided by 15 million. 80 cents of that was par value. The other $4.20 of that was paid in capital in excess of par. Okay, so what you said, that was correct. Now, what are retained earnings? And we talked about this way back in chapter 3. It's a simple question. Savings account, that's all it is. This is a corporation savings account. So when a company makes a profit and they get down to the very bottom line, they can basically do two things with that. They can either pay it out in dividends to shareholders, or they can put it in their retained earnings account. So far, this company has placed $31 million in their retained earnings account. So if we add up all of this information, this company has a 106 million, but then they have bought back $4 million worth of treasury stock. So they bought back 1 million shares at $4 per share for $4 million. So they've got total stockholders' equity of $102 million. Now, let me ask you this. Why would they buy back 1 million shares of their stock? And it has something to do with the price at which they bought the stock back. What did they pay per share when they bought it back? It's treasury stock. It's worth $4 million. They bought back 1 million shares. 4 million divided by 1 million. Okay, that's exactly right. $4 per share. Okay? The stock originally sold for how much? $5 per share. So basically what they're saying is they thought that their stock was undervalued at one point, and we don't know when, but it was undervalued. It was selling for $4 per share. And so they were going to buy it back because it was currently undervalued. That was a good financial move for them. Now, if their stock had been what they considered overvalued, then they probably would have tried to issue more of these 35 million shares. That's just kind of how it works. So if you see a company buying back stock, that sends a signal, and signals are really important when it comes to investing, because a lot of times a company, well, most of the time, a corporation is not going to come right out and say, this is why we're doing whatever we're doing. You have to be able to read the signals of the market. And so if you see a company buying back shares, that signals, hey, something's up here. This stock apparently is undervalued. Something's going to happen in the future, which is going to push the price up. We don't know what it is, but you'll see investors jumping in. If company insiders, like for example, the company president or some of the vice president, if you see them selling shares of stock, that sends their personal shares of stock that they own. That sends a signal to investors, wait a minute, something's up here. Why would they sell if they thought the price was going to go up? Apparently, they think the price is going to go down. They know something that we don't know. So you see investors, they'll start dumping their shares of stock in that company. Now, when insiders sell, when we'll talk about insider trading a little bit later, you have to be careful, because insider trading is illegal. So it depends on what they know, how much they know, in terms of what they're trying to accomplish. But again, we'll talk about insider trading a little bit later in the chapter. Okay, the answer to your question, I'm going to give you a very vague answer because that is the answer, is maybe. Nobody really knows, okay? What tends to happen on average, okay, I'm not saying this is every time, but what tends to happen when one company buys another company is when the announcement is made, the company doing the buying, its stock price typically goes down. Just what happens, okay? The company being bought, its stock price typically goes up when the announcement's made. And what people have to do and what investors have to do and analysts and everybody following these companies is they have to determine if Panera and its combination with its buyer is going to be a plus for the buyer or is it going to be a minus for the buyer. Some companies fit together really well. And so if I'm a corporation, I buy out another company that really improves what my company does, then eventually that's going to push the stock price up. But sometimes, even though you think all these business executives have to be really smart, sometimes they make some really, really stupid moves. Sometimes they'll buy out a competitor just to keep another competitor from buying it. And then investors are kind of scratching their head thinking, what are they thinking? Why are they doing this? All they're doing, they've already got this technology or this production facility or these distribution facilities. They don't need the company they just bought for those things. Why did they make the purchase? Well, sometimes that's a really good question, and you may see the purchasing company's price go down because they made a bad decision. So there's really no one right or wrong answer as to is it going to help or hurt. Only time can kind of tell that. All right, so let's go back here. A couple of other terms, and you might just want to write these you don't have to write the whole definition down. Write the words in bold down. You can take a look at them later. Authorized shares. This is the number of shares that the company can issue. Outstanding. These are the shares that the company has issued to this point. Treasury stocks. Treasury stock is typically shares that the company has bought back for some reason. And then you've got the issued shares. Shares of common stock that have put into circulation. And so you can take a look at this. You may say, well, what's the difference between issued and outstanding? Well, issued shares are equal to outstanding shares plus treasury stock. Remember, treasury stock is what they bought back. So for purposes of the final exam, you will want to know the definition of these items. But again, you can take a look at that later. You can go back and take a look at the definition. How many people in here have actually, or are actual owners of stock of some kind? Maybe you bought it, maybe somebody gave it to you. Okay, so a few of you are. Okay, good deal. Again, this is something that if you are interested in something like this, we do actually offer here at Murray State something called the TVA Investment Challenge. Dr. David Durr, whose office is right next to mine, he's the one who's in charge of that. But what that is TVA, the Tennessee Valley Authority, probably, 18 years ago now, they gave, just watching that wasp fly around. Students usually start getting really antsy when the wasps come out and start flying around this classroom. Gave Murray originally $100,000 along with, I think it was 19 other universities. So 20 universities, $100,000 of their own money to invest. So what they said is, Murray State University, we're giving you our money. We're going to want it back sometime, but we want you to take a group of students, and we want your students to pick out stocks, and we want you to invest this money and see what you can do with it and let students learn from this experience. Well, it worked out really well, especially for some students and for TVA, because for the first several years, Murray State University, we would place typically in the top 3 out of 20 universities every year. So they had a 1-year return that they used to measure. They had a 3-year return that they used to measure. And move. Don't move. Don't move. Didn't even leave a stain. That was my main worry, is it was going to stain the screen. All right. Yeah, it was center of your head. I mean, it was. I thought you were going to knock him out there for a minute. All right, if anybody's listening to this on Tegrity, we just had a wasp outbreak in class. We took care of it. The said wasp is dispatched now, so we're going to continue on with our class. What were we talking about? TVA Investment Challenge. All right. So we still offer that 20 years later. What happened was that TVA, they were decommissioning a nuclear facility, which means they were taking it down. It costs a lot of money if you've got a nuclear plant to basically take it apart. So they gave universities a very tiny amount, $2 million, and I'm talking, Murray State, Austin Peay's, University of Kentucky, University of Tennessee, UTM, Ole Miss, Mississippi State, Vanderbilt, big universities, small universities, whatever. Well, Murray State was coming out on top, a lot during that time period. And it turns out that the universities were actually outperforming the professional money managers that TVA had given to invest their money. Now, part of that could be luck, part of it could be maybe college students just want to be a little riskier. But anyway, they were doing really well, so TVA bumped up the amount that they were managing. So based on their performance, they gave Murray State more money and some of the other universities more money. I think now they might have taken some of it back, but at one time Murray State was managing around $800,000 of TVA's money. This is you making those decisions. What to buy, what to sell. This is really, really real world experience, okay? So if you're interested in something like that, sometimes it's taught as part of a class, sometimes it's taught as like just an independent type study thing. You can contact Dr. Dave Durr, and again, that's really good practice. You get to go to Nashville once per year to present your findings and to meet with professional money managers, and so it's just a good way to kind of learn about investing. All right. So, okay, that's talking about voting. All right. This is what we discussed earlier. Basically, two definitions here you need to be familiar with, undervalued and overvalued. The question that it asks is there such a thing as undervalued or overvalued stock? Well, some people think there are. Some people think they're not. Whatever a stock is selling for is exactly what it's worth at that time. So it's never undervalued, it's never overvalued. But if you have an undervalued stock, if they do exist, this is a stock that investors would want to purchase because you can buy it because it's selling for less than it's worth. Price goes up, you can then sell it, make a profit. If you own what's called an overvalued stock, it's selling for more than you think it's actually worth, that's a stock you would want to sell. Because you're thinking, one of these days, people are going to realize the stock's really not worth what it's selling for right now, so I want to go ahead and get rid of it now before the price goes down. So that's undervalued and overvalued. And we will come back to this a little bit later with something called the efficient market hypothesis, and we'll discuss are there undervalued or overvalued stocks. Now, some different types of transactions. We've got three listed here. We've got a primary market transaction, a secondary market transaction, and what's called an IPO or an initial public offering. You need to know the definitions of each one of these for the final exam. A primary market transaction is when a company that has already issued shares of stock issues additional new shares of stock. That's what's called a primary market transaction. Okay, so think of it as cars. This is the new car dealer. They sells only new cars. These are new shares of stock that are being sold. A secondary market transaction, this is when you have a sale of what's called seasoned or previously owned securities or stocks. So if I log on to my Scottrade account this afternoon and buy 10 shares of Tesla Motor Company, I'm buying those shares from somebody else. I don't know who. I don't care who. But those shares have been owned by somebody, so that will be called a secondary market transaction. They've been previously owned. And then you have what's called an IPO, an initial public offering. And this is when you have a public stock sale by a previously privately held corporation. And we've seen several of these over the last few years that made a lot of headlines. Facebook, when it went public, huge IPO. Twitter, when it went public, huge IPO. I mean, you've got a lot of these happening, and because if it's a really good IPO, it's tough for the average investor to take advantage of that. Now, the way this works is, with IPOs, a company wants to go public, so they contact an investment bank or a group of investment banks if it's big enough, a big enough transaction, and they say, look, we need you to help us determine what is our stock worth per share. We need you to help us find buyers for our stock, and for that, we're going to pay you a lot of money. So if you, for example, are interested in being an investment banker, now that's different than the banker that you typically deal with to cash a check or to get a car loan. Okay, that's called a commercial banker. But if you're interested in being an investment banker, you can make a lot of money. The downside is it's a very, very stressful job because you're trying to determine, for example, what is Facebook stock worth? It's never been sold. Shares haven't been sold, so we don't know what it should sell for. If you price it too low and we issue the shares to the public, Facebook loses money. If you price it too high and we try to sell shares to the public, maybe all the shares don't sell. So there's a ton of stress involved in being an investment banker. But say we're going to go public. If it's a good IPO, the investment banks start calling their best customers first. The ones who buy and sell millions and millions of dollars worth of stock each year from them. And they basically work their way down the list. They call their best customer and say, hey, we've got this great IPO. Are you interested in buying a few shares? Somebody says, yeah, I want 10,000 shares. I want 1 million shares. I want whatever. I will tell you that occasionally I get a call from a broker saying, hey, we've got an IPO. We'd like to offer you some shares. Are you interested in purchasing? The problem is, in terms of investors, I am a tiny investor compared to these big boys who are buying and selling millions of dollars worth of stock every year. So what that says is, and it kind of hurts to admit this, but I want you to learn from this, if a brokerage firm gets down to calling me about an IPO, that means nobody else wanted those shares. Nobody else was stupid enough to buy shares because not all IPOs are the Facebooks or the Twitters. You know, some of them are unheard of companies that are still going to be unheard of because they're going to go bankrupt in a year after their IPO. So what I'm telling you is, and I don't know any of your financial positions, but if you ever get a call from a broker wanting to know if you want to buy shares of an IPO, do your research. Because the first time you get that call, you kind of think, wow, I remember us talking about this in class. I must be moving up in the world because I got a call about an IPO. I can get in early on this. The problem is, if you're just an average investor with an average net worth, that means nobody else was stupid enough to buy the shares, who they called first, so they're hoping you are. So you want to be very careful about buying those shares. But again, that's what going public is. That's what it means. All right, so when it comes to valuing shares of stock, there's a ton of ways. And, you know, we're going to spend 2 days on this. We could spend an entire semester talking about stock valuation. We wouldn't cover even a fraction of it. You could spend a year talking about it. You're not going to cover a fraction of it. That's one thing that is so great about investing is some people are self-taught investors. Some people have had some formal education, but then you try to keep up with changes. With investing, you never, ever are finished learning. Warren Buffett. How many people have heard of Warren Buffett? Okay, Warren Buffett, probably one of the best investors. My wasp is still alive here. Warren Buffett is one of the best investors ever. One of the wealthiest men in the United States. Very successful. He learns something almost every single day. And Warren Buffett's probably in his mid-80s. I mean, I don't know exactly how old he is, but I mean, he's been around a while. He's seen a lot. Because what happens is, what happened and what worked 40 years ago for Warren Buffett doesn't work in 2017. So he has to keep up with changes in the markets, changes in consumers, changes in technology. He has to keep up with all of that, and any good investor is going to keep up with that to help them when it comes to investing. So it's just a constant study. But there are some different ways of doing this. One is what's called a dividend growth model. We're going to talk about 2 of these in class. That's what we're going to discuss. There's also other models: free cash flow, book value, liquidation value, and PE multiples. Now, I've got this here because I want you to read these on your own in the chapter and know the definition of each of these for the final exam. Okay? So, book value, liquidation value, PE multiples, and free cash flow. So be sure to get those down. You can take a look in your textbook at each of those. Now, unlike Chapter 6, where we dealt with time value of money, Chapter 7 is actually pretty easy. You've got 2 models. You're given the model, given the formula. You just plug the numbers in, really simple, and do the math. It's not complicated whatsoever. So let's take a really quick look at the basic model. Okay, so this is kind of our starting point. I know it looks messy, but we're going to simplify this. This is basically the same thing we did in Chapter 6 with bonds. Because remember, in Chapter 6, bonds, what we did is we took the present value of the future interest payments and the par value. We determined at the appropriate discount rate, what are they worth today, and that was the selling price of a bond. Well, with stock, the future cash flows come from either dividends or a capital gain or capital loss. So that's what we have listed here. We've got D1, which is the next dividend to be paid, divided by 1 plus the required return for the stock. That's what RS stands for. Plus D2 divided by 1 plus the required return raised to the second power, plus the dividend paid in year 3, divided by 1 plus, you kind of get the point here. And notice that, at least theoretically, these dividends are going to be paid infinite. So we could take this out to infinity, divided by 1 plus the required return, raised to the infinite power. Now, the problem with this, what this model says is summarized here. Okay, the value of a share of stock is the present value of the expected future cash flows. The reason that we can simplify this formula, because it would take a while to calculate the present value out to infinity. Okay, at least theoretically it couldn't be done. If you look at the dividends paid very far into the future, 30 years, 40 years, 50 years, 60 years into the future, once you take the present value of, let's say we've got this, okay? So we have, let's say a stock pays a dividend in time period 50. And that stock pays $1 per share dividend, and it has a 10% required return. If you take $1 and divide it by 1 plus 0.1 raised to the 50th power, that's going to be a really, really small number. the present value of the 50th year dividend adds a tiny amount to the price of the stock. The 51st year dividend is going to add even less in the 52nd year. So what that means is, based on knowing this and knowing how little that these future dividends, very far into the future, add to the price of the stock, what we can do is we can simply take this model and simplify it into something that looks like this at the bottom, where it says P0 is equal to payment, or you could write in dividend, divided by the required return, which is represented by R. Now, the first model that we're going to look at here is what's called the zero growth model. These are, when we talk about growth, we're referring to the growth of the dividends of the stock. Are they increasing every year? Are they decreasing every year? Are they staying the same? So with the zero growth model, it assumes, as the name implies, that the stock's dividends do not change. It may pay $1, or this stock's paying $2, so it's paying $2 next year, it's paying $2 2 years from now, it's paying $2 50 years from now. It's not going to change. And so what we're doing is we're valuing this stock like a perpetuity. That's what a perpetuity was. It was an annuity that lasted forever. Well, in this case, if this $2 paid out every year lasts forever, that's a perpetuity. And we said that preferred stock pays a fixed percentage of its par value each year, so its dividend doesn't change. So in addition to shares of common stock whose dividends don't change, we can also use this model to value preferred stock, because it is a stock whose dividends aren't changing. So this is how simple it is. This stock pays a $2 dividend. It's expected to pay $2 forever per year. The required return on this stock is 13%. So if we take the dividend divided by the required return, which is $2 divided by 0.13, this stock today, at time period 0, should be selling for $15.38 per share. That's all there is to it. It's not more complicated than that. So does that make sense, kind of how that's working? Everybody see where the numbers are coming from? You'll be given this formula, and you just plug the numbers in. I mean, that's all there is to it. So that's called the zero growth model. Now, you can see how we would value a share of preferred stock using this model. It works the same way. It says here, a value preferred stock pays an annual dividend of $5 per share, and the required return is 10%. What should the stock sell for? Well, it's going to be, and this stands for the value of preferred stock, the dividend of $5 divided by the required return of 10%. So this preferred stock should be selling for $50 per share. No more, no less. So again, really simple, really straightforward. I don't think any of you are going to have trouble with this. Now, the second model is what's called the constant growth model. So again, we're talking about the growth of dividends. So this is valuing stocks whose dividends are growing at a constant percentage each year. So maybe they're growing at 5% per year or 10% per year, whatever it might be. This is the actual formula down here, okay? Now, to be honest, this is the actual formula here. D1 divided by the required return minus the growth rate. G stands for the percentage growth rate. But I also have this listed, and you'll notice up here, I'm kind of showing you what this is telling you. What this says is, if we know that a stock is growing, a stock's dividend is growing at a constant rate, and we're given, for example, D0, D0 is the last dividend paid, and we know the stock is growing at a constant rate of 10%, if we take the last dividend paid multiplied by 1 plus the growth rate, 1 plus 0.1, we will then know what the next dividend is going to be. And if we know what that, I mean, this shows you if we want to take it 2 periods in the future, or however many periods in the future. So that's what this is telling. Now, the reason this makes a difference, you'll see when you work some of the practice problems suggested for this, and also some of the final exam practice problems. when you're reading through one of these problems, the wording is extremely important because it's either going to be worded as, and I'll just make this problem up. ABC Corporation recently paid a dividend of $1 per share. ABC Corporation stock is expected to grow at a constant rate of 5% into the foreseeable future. The required return on this stock is, what should it sell for? If you see that the dividend has already been paid, okay, which is what the problem stated, you have D0. But I also said the stock is growing at a constant rate of 5%. For the actual formula, we need D1, which is the next dividend to be paid. So if we took the $1 per share multiplied by 1 plus 0.05, that means D1 is going to be $1.05 per share. That makes sense, kind of what we're... Now, same information. If the problem reads, ABC Corporation expects to pay a dividend of $1.05 per share next year, it's growing at a constant rate of 5%, and its required return is 10%. What's the price of ABC Corporation stock? Well, if it expects to pay it next year, that's the next dividend to be paid, so it already gives you the $1.05 per share, so you're given D1, you don't have to worry about all of this stuff. And again, that's going to make more sense once you actually work 2 or 3 of these problems, okay? But this is what it looks like, and then you can see, oh, one thing that I want to point out too, is really important in the red down here. It says the dividend growth rate, which is the letter G, must be less than the stock's required return. This is a necessary condition for this model to work. So I'm not going to get into the mathematics of that. You probably studied necessary conditions in some of your math classes. Okay, this is just a necessary condition for this to work. And you probably will see a question related to this, that's one reason it's in red, on the final exam. Okay? So the growth rate has to be less than the required return. Otherwise, the model does not work. And you can see an example of that somewhere, I think. Okay, here. Where we're given, in this case, we're given D0, the required return, and the growth rate. So in using our information, we're given D0. So if we take $2 times 1 plus 0.06, that's going to equal a D1, which is $2.12. Everybody see where that number is coming from, the 212? And then divided by the required return of 0.13, which is here, minus the growth rate of 6%, which is here. And if we do the math, this stock should be selling for $30.29 per share. Straightforward. The only problem is, do you have D0 given to you or D1?
After we did for the 212 would be D1, and then to find D2.
You actually, no, you're given D0. You need D1. That's as far as you have to go.
I mean, like, if it's another question like that, so the next one would be 212?
That's exactly.
Oh, okay.
Well, no, that number's 212. If you wanted to find D2, it would be 212 times 1 plus 0.06. Yeah, find D2. Yeah, that's exactly right. And kind of breaking this down, and you don't really have to know a lot about this, but I wanted to explain it to you really quickly. I said that a stock's return comes from 2 different areas. So for this particular stock that we just dealt with, 7% of that 13% return came from the dividend part, and 6% is expected to come from the capital gain, which is a price going up part. So 7 plus 6 is our required return of 13%. But again, I'm not going to ask you anything about this, okay? So don't worry about the math associated with this. And then the third model that it discusses in your book, but we're not actually going to cover in class, is what's called the non-constant growth model. So you can look at the definition. It's simply a model used to value stocks whose dividends do not grow at a constant rate, so they change. This is something, it's just a little bit more technical. You could do it, just use this time value of money. But for this class, I think we have better ways to spend our time. So if you take another finance class, you probably look at this, probably go through this example. But for purposes of this class and this test, you're not responsible for the non-constant growth model. And that's a good place to stop. So on Thursday, we're going to talk about the efficient market hypothesis. We're going to actually look at some stock prices, how to buy and sell stock, that type of thing. So we're going to spend some time with that. Otherwise, remember, quiz 4 closes tonight. Quiz 5, which actually we've covered everything that you need for quiz number 5. Okay? So for quiz number 5, it opens today. It closes Saturday at midnight. Everybody have a good day. I will see you on Thursday.